Welcome to Nasdaq TradeTalks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. We're coming to you live from Mainnet 2024 by Masari, and joining me for this segment, we have Gregg Bell, Senior Vice President of HBAR Foundation. We're here to discuss standardizing tokenization. It is great to have you with us, Greg. Welcome to Trade Talks, and it's interesting, one of the key themes at Mainnet this year has been token standardization, which to me,
Sure.
I assume that the industry is starting to mature and you're getting more institutional interest there. Why do institutions need to think about that?
Well, it's such a critical question, right? And I think when institutions are choosing what protocols to build on, there's a couple things that really matter. Scalability for one, right? The ability to interoperate is very key. When you look at Hedera as an example, we've got over 70 billion transactions, with about 100 million that are occurring each and every day. That, in context, is about 25 times that of Ethereum. So there's a huge amount of proven scalability that's there. When we talk about token standards specifically, that's where the interoperability really comes into play. And when you think about blockchains as a trust machine, it's very important that there's the embedded level of trust and everybody's speaking the same language, so we don't have isolated pools of capital across tokenized products.
Yeah, well, I mean, it makes sense though, because you want to get it done right. You want to make sure that the data is valuable, it's structured, it's usable, and to your point, everyone's using or thinking about it in the same way.
Sure. Yeah, I mean, so that's where, RWAs can be a very broad section.
Right.
And so when we're talking about securities or we're talking about alternative asset classes, there's a variety of different components that play into what tokenization is. And really, it's a lot more than just saying, here's a receipt of ownership, and we're representing that on a blockchain. And we've been putting in a lot of work within the Hedera ecosystem to bring to market a couple of products that are open source to the development community as well as to broker-dealers and other asset issuers. The most recent launch is the Hedera Asset Tokenization Studio. So this is a tool that enables issuers to come to market with a compliant structure with a product that has embedded in it metadata that is beyond just that receipt of ownership. And that's where a lot of the very important characteristics of security or of any individual asset can be used as a single point of truth.
Right. Well, you can imagine what happens if you have all these inconsistencies across all these different types of tokens. Why have money markets and fixed income securities been key for institutions when you think about RWAs?
Yeah, so I think that's where we get back into the question around the data that's very important. One of the biggest problems that we're solving with tokenization is around reconciliation. There's billions of dollars that are being spent by financial parties reconciling individual trades. And when you think about fixed income products, if one party knows a different coupon or one party knows a different maturity date, these can flow into a broken trade, a failed settlement. And so having that data that's recognized on-chain as a single point of truth enables for efficiencies to be achieved within the reconciliation process. And fixed income products lend themselves very well to this sector. Now, as it relates to money market funds, I think that's the first of many products that'll be coming to market. And money market funds act as a means to give a yield to an investor base that may not have had access to checking accounts or other products in the past. So we're seeing a lot of adoption from crypto foundations, from stablecoin issuers that are naturally buyers of products that require yield.
Yeah, so let's talk about it from the asset management perspective, right? And how you kind of go from that lens of, rather than being a diversifying type of investment, more towards a longer term investment that lives within the portfolio for the duration.
Well, you can tokenize a lot of things.
Right.
And so an alternative asset is still an alternative asset, a bond is still a bond, and so the asset class carries with it the diversification characteristics of the financial product. But what it also enables is that new level of trust. And so we're seeing adoption from asset classes that have trust problems. Maybe there is a lack of integrity within an underlying collateral base. There was a time when all mortgages were viewed the same. And then when we discovered that somebody verifying the income of an individual made that borrower much less likely to default than someone saying, hey, I'm a billionaire, or I'm a millionaire, and you're just going to take my word for it. And so when you enable that type of drilled down transparency into an underlying collateral base, and in an open, transparent way, enable many different market participants to look and assess the product itself for its characteristics, who said what, when, where, and why. That's a very powerful thing, and that's what's being recorded in the digital twins of these products.
See, and I think that's a great analogy. That's something that I can understand and I can conceptualize. So let's stick with the mortgage analogy for a moment here. Mm-hmm. This type of technology, it can only advance the mortgage process, if you will, make it more efficient, make it more transparent. So there's still more work to be done in the mortgage space, as an example.
Yes, there is. I mean, across different asset classes, there's absolutely more work to be done. The early adopters, I think, are those that had the greatest trust breaches. The carbon market is a great example. We've seen a lot of use within the Hedera ecosystem and providing an integrity layer for carbon-related or sustainability-related financial products. And there was a lack of trust around whether there was true impact being applied to financial allocations for green bonds and other forwards and financial instruments. And when you can follow the flow of funds down on a very granular level, you can have greater trust in what is actually occurring. And that's where, with multiple parties, a distributed product, a distributed network, makes a lot of sense versus a centralized database.
It certainly does. All right, appreciate the insight, Greg. Thanks for joining us on Trade Talks, and thanks for joining me from Mainnet. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.